In this demonstration, we're going to look at how to calculate the internal rate of return and the net present value of a capital investment project. If we look at our sample data, we see that Corn Doggy Inc. produces and sells corn dogs. Austin Beagle Production Manager is considering purchasing a machine that will make corn dogs. Austin has shopped for machines and found that the machine he wants will cost $230,360. In addition, Austin estimates that the new machine will increase the company's annual net cash inflows by $40,000. The machine will have a 9-year useful life and no salvage value. We're also given selected data from the present value of an annuity table, and we're asked to determine the machine's internal rate of return, its net present value using a discount rate of 8%, and then to determine whether that investment is acceptable or not. So if we begin with the internal rate of return, how we calculate internal rate of return is to take the investment of the project, in this case the $230,360 cost of the corn dog machine, divided by the annual cash inflows that we expect from that project, in this case $40,000. That gives us an IRR factor of 5.759. If we keep in mind that this was a 9-year project, that is, the machine had a 9-year useful life, we consult the present value of an annuity table in the 9-period row, and we'll want to scan across until we find a factor closest to the number we just calculated. In this case, we see that the 10% column has a factor of 5.75902, nearly identical to the factor we just calculated. So what that means is the corn dog machine project has an internal rate of return of nearly exactly 10%. To calculate net present value, we have to take on a couple more steps. So the first thing we wanted to do is determine the present value of the future cash inflows. So remember, Austin expected this project to generate $40,000 in net cash inflows per year for 9 years. So we take the $40,000 cash inflow per year and multiply that times the appropriate present value of an annuity factor. In this case, again, we're talking about a 9-period project, and we're using a discount rate of 8%. So we see that that lines up with a PV factor of 6.24689. Therefore, the present value of those future cash inflows of $40,000 per year is $249,876. From that, we will deduct the initial cost of the project of $230,360, and we determine that the net present value is $19,516. Part C asked us to determine if the investment was acceptable using a cost of capital of 8%, and the answer is yes. If net present value is greater than 0, we can assume the project is acceptable. At the same time, if our internal rate of return of the project, in this case 10%, is higher than our cost of capital, in this case 8%, we can also conclude that the project is acceptable. Please revisit any part of this demonstration that you feel necessary. Thank you.